In this video, I want to talk through one of the most legendary portfolio setups of all time. This 3-fund portfolio has beaten over 90% of investors historically. You can set it up in 10 minutes and then you just forget about it. If you're considering how you want to invest or distribute your savings, then this is the video for you. And I'm going to explain first why it works, second what it is, and third how you can do it. I'm going to keep this short and to the point. If you do like videos like this, make sure to just drop a like on the video. It does help the channel out. And that said, let's go. Okay, now before we continue, there's a solution that is probably very relevant to you. And that in mind, I want to pause for a moment to tell you about the sponsor of today's video, Airwallex. If you are running any kind of online business or dealing with international clientele, you know that dealing with payments across multiple countries is a nightmare. Currency conversions eat into your profits, you're juggling all kinds of miscellaneous bank accounts, and every transaction just comes with these fees that start to add up. So that's where Airwallex comes in. And Airwallex powers over 150,000 businesses globally with one unified platform for global finance. They let you have one global account that gives you local bank details in over 60 countries. You can also collect and hold in over 20 currencies, convert funds across 60 different currencies at interbank rates, and also pay out funds locally in over 200 countries and regions. And so this is the go-to for dealing with international finance as a business owner. And so here's materially why Airwallex is a no-brainer if you are running a business with cross-border touchpoints. So first, it plugs straight into your existing stack, whether Xero, QuickBooks, NetSuite, Shopify, WooCommerce, etc. So payouts, invoices, and reconciliation happen in the background. That means less admin, fewer errors, and faster month-end reports. Next, Airwallex is your single global account for everything money. Again, you can spin up a multi-currency account with local bank details in over 60 markets. You can accept payments like a local with over 160 payment methods. And you can issue multi-currency corporate cards with built-in spend controls to keep team spending in check. And finally, as far as a material benefit goes, there are actual foreign exchange savings from day one. So you can hold funds in 20 currencies and pay out suppliers locally. And that means you skip forced conversions and unnecessary fees that eat into your margins. So you can keep more of what you earn, move money faster, and grow your business. And as far as the fine print goes, Airwallex is licensed, certified, and meets PCI DSS and SOC standards. So it is secure and compliant with specialized support for global expansion. And again, over 150,000 businesses in all corners of the world can attest to Airwallex's benefits. So all in all, if you're operating a business or work in one that deals with international payments, and that's whether you're an e-commerce selling to different markets, or you're a startup collecting payments from global clients, or maybe you're just paying suppliers and contractors who live overseas, then this is for you, and you can learn more right now at airwallex.com or hit that link in the description. And just to be clear, Airwallex is not a bank and product availability does vary by region, so you can check the website for more details about your specific location. That said, go hit the link, check out the Airwallex platform, and that said, let's get back to the video. And let me just say first off, when I said that this beats over 90% of investors, what I mean is it beats 90% of professional investors. So these are the high-paid money managers who do this full-time, and 9 in 10 of them are going to lose to what we're about to talk about. So the strategy is to buy 3 different funds, which are a collection of individual stocks or underlying assets, which cover a wide breadth of different markets and asset types. Now, the logic here is not that you're trying to beat the market, it's that you're trying to be the market. You're trying to capture all of the growth of the global economy as cheaply as possible. And the reason for this is simple, right? The best investor in the world, Warren Buffett, arguably, has beaten the S&P historically by about 2% a year. Nearly everyone who actively trades, and this is linear, just like the more you trade, the less on average you're likely to make. And if Warren Buffett only beats the market by 2% a year, what about the guy down the street that manages the local fund? So if you take this approach of just be the market as opposed to beat the market, then this is the type of setup that you can set and forget that has historically been the path to financial freedom for tens of millions of people. So there are 3 building blocks as far as those funds go. Now, the first is a fund that captures US equity or US stock growth. So you want to own a piece of literally every public company in America. And fund number 2 as a hedge is a collection of international stocks. And then third is a fund that represents bonds. And this is kind of like the shock absorber or anchor of the portfolio, because when stock markets crash, then your bonds will either hold their value or increase in value. So that's the strategy, but now I want to get into the exact 3 ETFs or exchange traded funds, which is like a mutual fund that you can buy. Now I'm going to give you 3 different fund types. The first is Vanguard, and this is the classic one since its founder is the guy who kind of championed this idea. The number 2 is Fidelity, which has no fees. So I'll give you 3 funds for Fidelity, 3 separate ones for Vanguard. And then I'll also give you Charles Schwab, so 3 funds of theirs, which do have pretty low fees as well. So for those 3 fund types, respectively, the funds that you want to invest in to capture US stock are VTI, FCROX, and SWTSX. And these funds literally own a piece of every single public company in the US, so you really do become the market in this metaphorical sense with your portfolio. Now for international stocks, you're talking about the VXUS, FCILX, and the SWISX. And these are the same thing where you're buying many thousands of international companies through this one little fund. And then finally for bonds, you have BMD for Vanguard, FXANX for Fidelity, and SWAGX, as I like to call it, for Schwab. So cumulatively, these 3 funds give you ownership in over 15,000 equities and 10,000 bonds around the world. It is one of the most diversified, low-cost portfolios simply on the planet. Okay, but the big question that you may be thinking of here is, well, what's the allocation? Do you go 30-30-30? Do you go 50-30-20? And what I mean by that is, do you put 50% of your money in one fund and 30% in the second, 20% of the other, right? What's the distribution or the weighting of your money into these funds for this strategy? Now I'll give you the rule of thumb, which is subtract your age from 110. So for example, I'm 20 years old, so I would subtract 20 from 110 and get 90. And that's the percent of your money that should be in stocks. So I would allocate 10% of my portfolio following this strategy to bonds, and then split the 90% among the US and international stocks. Now, as far as the percent of money that you invest in the US stock fund versus international, the general rule of thumb is either 70-30 or 80-20, favoring the US, because historically the US stock market just does so much better versus international funds. So for example, if you are age 25, the rule of thumb would be 60% in your US stock fund, 25% in international funds, and 15% in bonds. But now if you're nearing retirement age, let's say you're 55, then that split would be 40% of your money in the US stock fund, 15% in an international fund, and another 45% in the bonds fund. But that said, if you want kind of a more risk, more return inclined portfolio, you shift more of that money into the US stock fund and less of it into bonds. And that's it, right? If you have that kind of portfolio, you are statistically setting yourself up for success, then you can just let it run. You can basically never check your portfolios if you don't want to. Now, there are 2 things you may want to do. The first is just, of course, buy more over time. So if you are checking your portfolio, that's just a dollar cost average in over time. And number 2, you may want to do this, say, once per year. You may need to rebalance your portfolio. So if stocks had a really good year, that 85-15 might have become 90-10, and then you want to sell off some of the stocks and put some of that money into bonds. Or if you want to pursue, again, a more risk-inclined portfolio, you can just leave it like that. But there you go. That is the tried and true method for long-term compounding through public equities in the bond market. And this isn't a fit for everyone. If you love finding the next Amazon and investing in stocks, then go for that. If you love real estate and that's your game, go be an awesome real estate investor. But this strategy right here, combined with home ownership, is what has born the whole middle class of America, and is how a vast majority of people have become millionaires. And I mean out of the subset of people who have become millionaires, not everyone, over the past 100 or so years. If you enjoyed this one, make sure to leave a like. It does help the channel out. And that said, I appreciate your time, and I'll see you in the next one.